Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and I'm also finance presenter and columnist for the ABC.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café. Now, James, you've been up since, 2 a.m. or something?
Something like that, yes.
Looking at the NVIDIA results, quarterly results. What happened? What do they make?
They were pretty good. They made something. They made $47 billion in revenue. That's US dollars in revenue, and 26 US billion in profit. Both were ahead of estimates, which was pleasing. Guidance came in for the next quarter. Next quarter's revenue at $54 billion, which was just above consensus, although some people were looking for $60 billion in third quarter revenue. So the stocks are off a little bit in after hours trade. But look, I think this basically says that the AI boom is continuing. Jensen Huang, the CEO and founder, did his usual sort of shtick of saying how great AI is. So I don't think, there's definitely nothing in here that is going to concern the market. There are a few sort of interesting things, like the law of large numbers is starting to hit NVIDIA. You know, their quarterly growths come back from sort of 69% a year ago back towards 6%, which would be, any other company would love quarterly growth at 6%. But the problem with NVIDIA is there's so many eggs in this basket. It's 8% of the S&P 500 now. It's NVIDIA's revenue is reliant on a handful of big tech companies. So if NVIDIA cracks, the whole tech story cracks, and the pain would be immense. So that's the thing that scares me, but we're not at that point yet.
What's the law of large numbers?
Well, it just gets harder. When you're putting up huge numbers for sales profit, it just gets harder to grow them because they're so big.
Do you think they are the first 100 billion a year profit company?
Not sure. I mean, it's possible. Totally. Year. I mean, they're doing that now, really.
So that's what I'm saying. 26 billion in a quarter is a run rate of 100 billion.
Yeah, I can't think of anyone who's matched that.
No.
You're right.
Yeah.
Pretty funny,
there you go.
Yeah.
Well, that's something. It's really something.
Yeah.
Oh boy. I mean, and have you've let's just talk about we're talking about reporting, companies reporting. You had a piece the other day saying that the headlines was that the reporting season in Australia is a stinker. So why is that?
Well, look, I guess what we'd say there is there's been more misses than beats on the revenue growth. And so the way that companies and earnings beats are, they're just below the sort of long-term average. So there's nothing really impressive here. For a stock market that's at 9,000, that's at record levels, these aren't the earnings results you get usually when stocks are running. So I guess that's my point. What we're seeing is companies cut their way to growth. There's a lot of cost cutting across the market at the moment. Now you can do that this year. Maybe you can do a bit more of it next year, but eventually you've got to grow earnings. And that's the disconnect I don't get in this economy. We've literally just had an economic roundtable that was about how moribund the economy is, and yet Australian investors have pushed the ASX to unheard of levels based on the with no earnings growth. So I keep saying something doesn't add up, and I keep being proven wrong. So you can file that under W for what would I know?
But you're the stop clock, James. It'll eventually you'll be right.
Yeah, maybe.
I mean, but the other thing about the reporting season is that misses are being really treated harshly, aren't they? I mean,
the swings,
big hammerings of stocks.
Absolutely shocking.
Like Reece. Talk to me about Reece, because the thing about what interests me about Reece, the plumbing business, is that it's yet another company that's fallen over in the US.
Yeah. Look, I mean, I've never heard an earnings call like this, Alan, and I do, 30 or 40 every season, twice a year. I've just never heard anything like this. Peter Wilson, the CEO, and the son of one of the co-founders, three brothers founded Reece in Melbourne. You know, I don't know, 50 years ago. He just got on and said basically, well, I mean, really, he said the joint's stuffed and it's not going to get much better. In Australia, things have structurally changed with housing construction's down, but his argument is that costs have structurally shifted higher, and so margins aren't as good. But yeah, the big problems in the US, where they went into the US a few years ago, 7 years ago, sort of knowing they'd bought a company that needed a lot of work, but they've been hit by this double whammy, because not only does the company need work, and one of their competitors are coming at them hard, but the US mortgage market, though the US housing market's got this weird problem that we wouldn't identify with in Australia. In America, of course, everyone's on a fixed mortgage, and everyone fixed their mortgage during the COVID period when rates got down to 2 or 3%. So everyone's sitting on a 30-year 2 or 3% mortgage. So
their mortgages come up for renewal in 2050.
That's right. So what does that mean? I don't want to move. If I move, I'm going to have to get a new mortgage at between 7 and 8%. So in Peter Wilson's words, the US housing market is frozen. No one is going anywhere. No one's doing any work to their house, because when you move, often you get in there and remodel and fix the plumbing and all that sort of stuff. So it's a unique set of circumstances. But what's interesting to me is even after this, Wilson, as you said, Reece's stock was hammered off 22% on the day. It's still trading at 27 times next year's earnings.
Yeah, so it's got a bit more to fall.
I mean, you could buy Microsoft for that or similar to it. So there are some stocks on the ASX where you just look at it and you go, what are we buying here? But anyway.
Talk to me about, just before we get on to Mr. Trump and what's going on over there, talk to me about Coles and Woolies.
Well, easy. Team Red, Coles is absolutely smashing Team Green, Woolies. Woolies just hasn't recovered any momentum from the sort of firestorm it went through last year with the price gouging accusations, the supermarket inquiry by the ACCC, the departure of Brad Banducci. It's sort of lost the trust of shoppers, as it puts it, and it's trying to regain that.
Yeah, I wonder if it's a bit like Essendon Football Club, because this is my team, of course, and we've never recovered from the supplements saga.
Yeah.
And I wonder whether that was kind of Woolworths supplement saga.
Maybe.
Which takes a long time to get over, something like that.
Yeah, they're investing heavily to lower prices, but it's not really working yet. We're not seeing the sales growth. In the first 8 weeks of the 2026 financial year, Coles sales were up 7%, excluding tobacco sales. Woolworths were up 4%. So there's that gap they just can't close. Now, unlike in football, Alan, you can spend your way out of these problems. Brad Banducci did it back in 2016. He put $1 billion into lowering prices over the course of 18 months. But Woolworths CEO Amanda Bardwell, she's only putting $100 million in. And the analysts, the market just doesn't believe it will be enough. Basically, they say Woolworths needs to start a price war to get shoppers back in its supermarket.
But isn't it the case that they can't actually win a price war against Aldi?
Not sure about that. I mean, look, I think the main competition's still between Coles and Woolies. But you definitely can't bring shoppers back without lower prices. So what do? Yeah, okay, it hurts profitability, but unless you're keeping customers happy, the sort of drift of this company could continue. So I'm
going to Woolworths now because they've got this, in the one I go to, they've got this thing where you scan the product into the trolley.
Yeah, okay.
There's a thing that they have a screen. You get a screen on the front of your trolley, and there's a little thing at the bottom of it where you scan your barcode there, and it keeps a tally of what you're spending, and you put it straight into your bag that's in the trolley.
Mm.
And when you go to checkout, you just pick up your bag and walk out. It's great. I love it.
There you go.
I'm not that focused on price anymore.
Fair enough. Well, look, I mean, it's interesting. What I would say is there is a big push towards convenience, like you've described, Alan. You know, whether that's online sales or direct to boot sales, where you don't have to go into the shop. The change in the market here is really interesting, and I think the nature of the sort of traditional physical supermarket is going to change over the next 10 years. So maybe that's another chance for Woolies to get back in the game. But yeah, they need it at the moment.
So just moving on to Trump and his attempt to fire his decision to fire one of the Federal Reserve governors, Lisa Cook, which the markets have not reacted to.
Yes, it's interesting, isn't it?
I mean, the VIX index has gone down, not up, which is the volatility index. The stock market is not unchanged, and the bond market's barely moved. So, I mean, everyone's kind of getting hysterical about it and saying that Trump's going to control the Federal Reserve.
What do you? I'm in the camp, Alan, that these things don't matter until they do, and then they really will matter. What do you think? Will this come back to bite investors at some stage?
Well, everyone's talking about that he'll have 4 people on the Fed, the FOMC, and he'll control the thing, but that's not true. So the way it works is the Federal Open Market Committee is what determines interest rates, and there are 12 people on that. There are 7 Federal Reserve governors. The chairman of the president of the New York Federal Reserve Bank is always on it, and then 4 other Federal Reserve Bank presidents from around the country. I mean, I can't remember how many there are, but a lot of cities have Federal Reserve banks. And there's a rotating thing of 4 of them go on to the FOMC as well, and they get a 1-year go at it so there's a kind of constant revolving presidents of the Federal Reserve Bank. So Trump will have eventually 4, if he gets Lisa Cook removed, 4, because he appointed 2 in his first term. There's a vacancy from a woman who quit on August the 8th.
Yes.
Whose name escapes me. But anyway, he said he's going to appoint Stephen Moran to that vacancy. It hasn't actually happened yet, so it's vacant at the moment. That means there's 11 people on the FOMC, but there'll soon be 12 because he'll appoint that person. And if he fires Lisa Cook, that'll be 4 that he's appointed. But that's only 4 out of 7 of the Fed governors, and they don't. But it's 4 out of 12 members of the FOMC. So he won't have a majority of the FOMC. Yes, he'll get to appoint the chairman next year when Jerome Powell's term finishes in May. And there doesn't seem to be any sign that he's going to try and fire him. So that'll still be. He will have appointed 5 of the 7 Fed governors, including the chairman.
Yeah.
But still, he won't have a majority of the FOMC. So I think that probably the markets are looking at that, thinking, well, it'll be okay. He still won't be able to bring interest rates down. He and Besant have been talking about 3% Fed funds rate, which is another 1 or so percent down from what it is now. But that won't necessarily happen.
Yeah, I think you've got to step back here, Alan, and look at the direction of travel. US interest rates are coming down, whether it's through the combination of weakening job market, political pressure from Trump, which I think, I take your point about the sort of mechanics of the way the vote is taken, but I think the pressure is just huge. So I reckon you sort of got the thing where equity markets are looking at the idea that interest rates are coming down and saying, "New beauty, we'll have some of that." Here's a chance to juice the economy a bit. But I think once we get down the track and we start to, the Fed chair is a Trump person, I think that we might start to the long-term bond markets, the long-term bond yields will start to push higher because it's going to become pretty apparent that these guys are just going to let the economy run hot.
Yeah, so and that's the other thing. As you said before, the majority of people in the US are on 30-year fixed rate mortgages, and the interest rates on those mortgages are set not by the Fed funds rate, as they are in Australia, by the cash rate the RBA sets, but by long-term bond rates. And they're, as you say, they're rising, right? So actually bringing down the Fed funds rate to 3% won't actually necessarily bring down mortgage rates.
No.
And in fact, the last time the Fed funds rate was at 3%, the mortgage rate, the average variable mortgage rate, was above what it is now.
Yeah, right.
So it sort of, it doesn't follow that mortgage rates come down. So Trump actually said in that cabinet meeting that took place this week that we'll soon have control of the FOMC and we'll be right, and interest rates will come down and the housing market will swing, as he put it. Well, that's not necessarily the case at all.
Those fixed mortgages just make the swing hard. I mean, that's what Reese is telling us.
And also, everyone in America is complaining about house prices being too high.
Yes, that's true.
So I would have thought the last thing anyone wants is for house prices to go up again some more.
Yeah.
I
mean, it's a fascinating / risky moment, I think. You got stocks at all-time highs, house prices at all-time highs, gold at all-time highs, crypto at all-time highs, and now we're going to get all of this stuff juiced by rate cuts. It's interesting. It's an interesting moment.
And just before we get on to questions, what did you think of the roundtable in the end?
Look, I thought I liked Jim Chalmers' sort of final speech. I thought he struck some sort of hopeful notes, but I just wonder how ambitious we really are. I mean, you've made this point so eloquently, Alan, and I've stolen it several times. We have so many of these crises in our country. We've got a crisis in the energy transition. We've got a crisis in housing, but you never see any sort of crisis action coming out of governments or, there was no suggestion that, look, we know that the sort of national planning framework for housing and energy transition is stuffed. Everyone agrees with that proposition, but where was the Feds are going to seize control of it for the next 2 years to just knock some heads together? I don't know. I mean, instead we got a sort of grab bag of stuff that's already happening and EV road user charging.
I love the fact that one of the big things that came out of it was that we're going to pause the National Construction Code for 4 years. Yeah. I mean, what they didn't say is that the National Construction Code for residential houses is changed every 10 years, and it was last changed in 2022.
Yeah.
So therefore, it's not actually due to be revisited until 2032, which is 7 years away. So
it only runs to 2,000 words and 2,000 pages in its current form, Alan. So it's a huge win for productivity, I would have said.
Well, that's right. I mean, it's already causing a problem, and they're just going to pause it for 4 years, which will be meaningless because there wasn't going to be any changes anyway for the next 4 years.
Yeah. Anyway, look, I think it was a worthwhile exercise to go through. I think there's some signs of consensus, which is good. I guess the question I'd have, Alan, is does it already feel to you like it's faded into the distance? I worry how they're going to seize on the momentum, but let's see. I mean, let's hope I'm wrong. Basically,
well, yeah. I mean, I presume the point of the thing was to try and get the business and unions locked into some sort of consensus.
Yeah.
But I think that's a forlorn hope.
Well, look, I mean, when I saw Chalmers made a bit of and the unions made a bit about the consensus between the ACTU and the Tech Council of Australia on AI regulation. That the Tech Council sort of agreed that copyright protections are good and, can't argue with that. But then immediately after that, this week, we've had submissions from Microsoft and one of the other tech giants saying, nah, let it rip. You got to let it rip. You just get out of our way. I mean,
yeah.
I just wonder whether that genies like that are so far out of the bottle. Australia's not going to stop it.
Yeah. Okay, before we get to questions, let's have a word from our sponsor.
With nearly 400 ETFs on the ASX, choosing the right one can feel overwhelming. That's where the InvestSmart 2025 ETF scorecard comes in. The free report takes a deep dive into the performance of ETFs and reveals the best and worst performance over the past 12 months across a number of key categories. And every ETF gets a star rating out of 5, helping you focus on long-term quality, not just short-term returns. Download your free copy today at investsmart.com.au.
First question from Matt. It was more a statement, I guess, than a question. He says, love the podcast. Young residential builder and golfer here. All this talk from non-golfers about reducing the number of golf courses to aid in the housing crisis is beyond me, particularly as I drive past the lush, sprawling grounds of the King's School in Sydney's northwest suburbs. The school had 2,157 students in 2024 and almost 148 hectares of land. That's 14.6 students per hectare. So they're probably...
And he makes a good point, Alan, that, young tradesmen have a very high suicide rate, and perhaps we should be acknowledging the benefits of being out and in the outdoors having a game of golf before we just kill all these golf courses off for housing.
Yeah, and he finishes on a serious note. As a tradesman that enjoys the game of golf and acknowledges that the construction centre has the highest suicide... Oh, you did. That's right, you said that. Yeah. Perhaps the keyboard warriors should try it first.
Yeah, Alan. Leave our clubs alone. An AI admirer says, as AI begins to automate knowledge work and reshape economies, how might we restructure our tax systems to capture value generated by AI without stifling innovation? Could we see frameworks like robot taxes or AI-based capital levies? And are there lessons in global governance that Australia could adopt? That's a really good question, isn't it, Alan? I don't quite know... I think that idea that we need to tax the profits or outgoings of AI in some way to help fund universal basic income and other protections for the parts of the economy that are hurt by AI is a sort of there's an attractive logic there, Alan. But is it, given our record on tax reform, are we going to be able to pull something like that off?
Yeah, look, I don't know. I think one of the problems with AI policy is that there are some people who say, some experts who say that AI is going to replace a whole lot of human beings, and there'll be a big decline in human employment. And there are a whole lot of other experts who say, no, that's not going to happen. It's just going to enhance human activity and will not lead to large amounts of unemployment. So you kind of get to choose which of your forecasts you prefer.
Yes.
And then, so, therefore, it's quite possible for the government to just go along saying it'll be okay. We don't need to do anything. Employment will still stay robust and we'll still get enough money from income taxes. But it is true that obviously part of the roundtable and everyone else is trying to think about, well, actually, there is a structural change going on with the working population in relative decline versus the baby boom retirees. So one of the things that the Treasury and the government has to think about is, what are we going to do about that? Which is probably going to be, to some extent at least, exacerbated by AI.
Yeah.
Because, it is the case that some people are being replaced by AI. There's clearly call centres are going to be replaced, for example. And so, the people paying income taxes probably will decline in number. So, they are going to have to think of something else. So, therefore, on the front page of The Australian today, there's kind of, the government's coming after your wealth taxes. We're coming after your wealth. And that's probably right. I think they're going to have to do something.
You're going to have to do something, yeah.
Other than income taxes. I don't quite know what, because probably whatever they do will result in them getting, losing a lot of votes.
Yeah. You can see I think the phrase used in the Oz today is generational war on oldies, and that's how it'll be portrayed. So the wealth, any adjustment to wealth tax is going to be brutally hard fought, isn't it? Anyway.
Yeah. Okay. My turn. Mary says, regarding the potential working from home tax for Victoria, as reported in the Herald Sun for people who work 2 days or more from home, as this is a land tax, how would it work for renters? Is it for homeowners only? How can that work, taxing homeowners and renters differently for whether or not they work from home? It doesn't seem rational. Would a landlord just get extra tax for each tenant who works from home on top of their own work from home tax? Not asking about a bedroom tax, as I anticipate you'll get lots of questions on that this week, but I think that's stupid too. Just because it's none of the government business if a couple shares a room or not, and many employees specify with space, working from home space must be on its own space. I don't know. Well, I think, yeah. What is Victoria proposing with the worth?
So I don't think this is Victoria proposing it, but the argument is that there has been some experts who've said that that people who do work from home could be charged with a percentage of otherwise exempt land tax on their principal place of residence, linked to the amount of time they're working from home.
Oh yeah.
So I can see the argument. I wouldn't get too concerned, Mary, that we're going to get to that point yet. I don't think that's the part of the Victorian government's plan. The Victorian government's plan is basically to win some votes in a cost-free way by enshrining work from home for 2 days a week in Victoria, or the right to do that. So, but I don't think I have seen no evidence of this being linked to any sort of tax.
I mean, there is a solid argument for it, because people who work from home, I'm pretty sure, will be deducting mortgage, heating, cooling costs from their tax, right?
Not mortgage, I wouldn't have thought, but yeah, some of those other costs. Yeah,
mortgage. Oh no. Well, okay.
No, you claim through there's various ways to do it through the tax office, but you basically claim a daily rate now.
Oh yeah.
So yeah. Yes, I see the sort of double taxation point, but I don't know. I wouldn't think that's the the main game here, so to speak.
No, right. No. Your turn.
RC says, what do you make of the recent reversal by CBA? This is about how they did a sort of embarrassing U-turn about AI job cuts. So they cut 45 jobs out of a call centre ostensibly because they were deploying AI, and then reversed it only a matter of weeks later to say, oh, actually, we need those people. And RC says, you often sing the praises of CBA leadership, and maybe longer term, this is a bump in the road. But what do you make of it? Alan, I thought this was a bit... It wasn't a great... this hasn't been well handled by CBA management, definitely.
Right.
I think the idea that we're getting it, job cuts from AI, is it is happening. Whether CBA sort of wanted to make that clear to the financial sector union that was a possibility, I'm not sure. But backflipping on it so quickly, it's a bit un-CBA-like, to RC's point. It's just, a little. It is embarrassing, no question.
Yeah. Andrew says, I love the podcast. With all this productivity roundtable talk, I've been looking at negative gearing, as it's something I've never really understood it as being good for the vast majority of people. If it was scrapped or scaled back significantly, wouldn't the savings to the government be quite large? Is there an actual estimated figure? And those people who would have invested in houses to make a buck might end up investing more in the share market, which is also good, isn't it? So the answer is that it costs the budget about $6 billion a year, and the capital gains tax discount costs about more than twice that. But focusing on negative gearing, $6 billion. It's a rule that applies to all investments, not just property. So it actually applies also to share investing. If you're losing money on your investments, you do get to deduct that loss from your other income. That's what basically negative gearing is, and we've had this a long time. I haven't been able to actually find out when it was brought in. If it was brought in, it just kind of seems to have just been there forever.
Andrew does make a good point, though, Alan. Stuff like this didn't seem to get much of a run at the Productivity Roundtable, or certainly for what we've heard post. It doesn't seem to have factored much into the conversation.
Yeah, the Labor Party proposed confining negative gearing to new houses. That is to say, if you can only deduct losses from a property investment if it's a new house. That was in 2016 and 2019, and they lost the election. So, I don't think that's going to come back. I think the Labor Party's scared of it.
Yeah. No, I think you're right.
The coalition won't do it.
David says the 1.5% training levy proposed by the ACTU is not a new idea. PM Paul Keating had introduced the exact idea in the early 1990s, but John Howard cancelled it after coming to power. Imagine how far down the skills road the country would have been if it had stayed in place. It would have changed the workplace skills in Australia the same way as Keating's compulsory super has changed retirement incomes. More of a statement than a question, Alan, but...
I was glad David did that because I'd forgotten about that, to be honest.
It's an interesting point, isn't it?
Well, when I saw that proposal from the ACT, I thought, oh, yeah, that's good. Let's do that. I mean, of course, companies should be training their staff. I mean, they're just outsourcing all their training to universities and TAFEs.
Yeah.
And the staff themselves have to pay it in their HECS, and they pay it back after they work. I mean, I think what's happened is that all these companies have basically unloaded the cost of training onto the staff.
Yeah. And when you ask companies about what do we need to do to improve productivity, whether it's the first or the second or the third thing they say is always skills and training. They always say, we need better graduates. We need a deeper pool of workers in engineering, technology, whatever the sector is. So David does make a good point that the compounding benefits of something like that are something we struggle to see. If you do something, you make a substantial investment for training over an extended period. The benefits compound as, one person gets more and more skilled and, that flows through the economy. So it is a good point. Again, another idea that was proposed and just seemed to disappear into the ether. I don't know. Maybe we won't see it again. Maybe it was knocked down by the business people in the room. But, yeah, it's just...
Well, the business people all came out one after the other hysterically about it, saying what an absolute outrage it would be and can't possibly have it.
Yeah, but I guess my point is, Alan, we saw lots of good ideas in the lead up to this roundtable.
Yeah, that's true.
Where are they all gone?
There were 900 submissions, in fact.
Yeah.
Where have they gone? Nowhere. Jason says, question for the podcast, why does the RBA only ever cut rates by multiples of 0.25%? If the decision to cut rates is so difficult to make, why not cut by something smaller, like 0.125? Also, ever since the RBA cut rates to 1% back in 2020, we have been carrying forward this 0.1% hangover, which has been keeping me awake at night.
Oh,
Jason, come on.
Jason. I sort of get the point here. Like the Fed always likes to go in nice, neat multiples of 0.25%. And I reckon the RBA deep down would love to be back in that zone. But then I sort of think about it and like, what does it matter?
Yeah, it doesn't matter.
It doesn't matter at all. It's the official cash rate. What you pay on your variable rate's probably some bizarre number anyway. It's definitely not a round number. So I'm not quite sure what it matters. I think it adds a little bit of interest. It does raise the interesting question, though, Alan. Is there a time when the RBA goes away from the traditional quarter point move and says, oh, well, why don't we just tweak this a little bit? I think Jason does have a point there that why are we fixated on the quarter point move?
Yeah, I don't know. I mean, they're certainly stuck in that. I mean, obviously there was one time when they cut by 0.15.
Yes,
which is when it got to 0.1 because they didn't want to go to zero.
Yeah.
And so the cash rate was 0.25%, and we don't want to have zero, so we can't cut by 0.25. We have to cut by 0.15 and get to 0.1. So that's what they did, and that was in what was it, 2021 or 2020? I can't remember. Yeah. Anyway, so it has been done, but only kind of because of an extreme situation.
Oh, hopefully Jason can get some sleep anyway, because I think it's going to be a long wait before we get back to the round numbers.
Yeah, that's right. Jason, Get some sleep, mate.
Yes. Carol says, love the podcast. I have a sizable amount of money that I intend to take out of my share portfolio because of the new rules that will come into place. So I presume Carol's talking there about the taxes on unrealised gains. I have 8 grandchildren. 4 are over 18 and 4 are under. I really want to somehow give them the advantage of this money. What's the best way to go about this? Alan, you're a man of sizable means.
No, I'm not.
How do you give your money away?
Well, first thing I would say is, Carol, don't do it for a start. Don't do it because of the tax, because it's not, it'll hardly cost you anything at all. It's being blown out of proportion by government's opponents. As for grandchildren, look, I don't know. 4 are over 18, 4 are under. You could just give them the money.
Yeah.
If you wanted to, just give them some money. Or else the alternative is, if you don't want to just give them money, you could sort of put it into an account with their name on each of the accounts and say that you'll give it to them when they buy a house or at some other point in their life.
Yes.
And if you want that rule to be in place, whatever the rule is you decide on, you want it to be in place after you've gone, so that because you're not there to make a decision about it anymore, then you'll have to put it in your will. You just write it in your will.
Yeah. I was thinking about this, Alan. I think the interesting part is how do you make it fair or do you need to worry about making it fair for the kids over and under 18? For example, do you want a sort of time when the money can be accessed? I don't know, when they're 25, or do you link it to some sort of life event like buying a house? That might be the way to do it.
I do think you've got to. You really need to divide the amount by 8. I don't think it matters whether. Personally, I don't think it matters whether they're over or under 18.
No, I guess it's just the timing of access to it, right, is the interesting thing. Like, do you, practically, how do you give I'm picking a number out of the air, but how do you give a 10-year-old X thousands of dollars? Like, what do they practically do with it? So to your point, do you hold it in some sort of account for a period and then, release it when they reach a certain age or achieve a certain milestone? I think that's what I'd be thinking about, and maybe talk to the parents and even the kids themselves.
When we came into some money when we sold the business, I just gave the kids money. I didn't muck around. I didn't make it conditional. I didn't say that it goes away if you get divorced. We just said, here's some money.
Yeah.
And they weren't under 18 at the time. Obviously, they were in their 20s. But still, what happened was that they were terrified of it. They certainly didn't go and spend it on overseas trips and, going to the discos. They just basically sat on it until they bought a house.
Yeah.
So I do think that having a lump of money will, focus their minds to some extent. But look, if that's fair enough if you don't want to just give it to them, particularly if some are 12 years old or something. You could put it in an account and say you'll get it when you buy a house or whatever event you want to tie it to.
Yeah, I think your example there is a great reason for Carol to have a chat to the kids too. What are they? How would they feel about the money? What are they sort of?
Yeah.
What are their aspirations and goals? Like, is it home ownership? Is it something else? Starting a business? Don't know. It might be different for all of them too. So, yeah, I think we may have just reached the old man zenith on this podcast too, Alan, when you said they didn't go and spend it at the discos.
Oh yeah,
you're showing your age there. I think
I was struggling for some kind of non-travel thing to spend it on.
Love it.
Discos.
Very
funny,
good.
isn't it? All right, okay, that's it. Thanks everyone for listening to today's episode of Money Cafe. I'm off for a week. I'm going to Bali, and I'll be back in 2 weeks' time. So next week it'll be James and Stephen without me. So until a couple of weeks' time, I'm Alan Kohler, founder of Eureka Report and the person on the ABC. And just a correction from last week, I said that in order to get the weekend briefing that I do on Saturday mornings, you need to subscribe to the whole of Intelligent Investor. But that's not true. I forgot that you can actually get Intelligent Investor Essentials for $330 a year, which includes not only the weekend briefing, but also Evan Lucas's markets briefings, all my CEO interviews, the Talking Finance podcast I do every week, and latest markets and economic stuff. So it's a good package, absolute bargain, and it includes the weekend briefing for just $330 a year, which is much less than the whole of Intelligent Investor.
And I'm James Thomson, Senior Chanticleer columnist at the Australian Financial Review.